Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Great to be here.
So today we are digging into what might be, and I'm not exaggerating, the single most disruptive financial headline we've seen in years.
Oh, absolutely.
If you've glanced at the markets at all in the last, 48 hours? Or even just scrolled your phone, you know what we're talking about. President Trump has proposed a federal cap on credit card interest rates.
At 10%, a
Yeah.
flat 10% APR.
That's the number that has Wall Street completely spinning. And look, we need to be clear about the timeline here. We're recording on Friday, January 16th, 2026.
All right.
The word is this is moving toward an executive order with a target date of January 20th. That's next Tuesday.
The clock is ticking loudly. And I think it's important to frame why this is such a shock. I mean, this isn't just about, cheaper debt for people.
So,
It's a fundamental collision between a political goal, which is, easing inflation for households, and the hard physics of how banks actually manage risk.
exactly. And that's our mission for this deep dive. We're going to get past the headlines. We've been looking at market analysis from Bloomberg, some reports on the legality of it all, and what it means for payment processors. We need to explain the invisible machinery that just breaks when you try to do this.
It does break, because when you artificially cap the price of something, especially money, the market doesn't just go along with it. It reacts.
And it has been reacting. So let's start with that headline risk. The moment this dropped, bank stocks got shaky. But it wasn't a uniform drop, was it?
No, because the market absolutely hates uncertainty. What we have is a proposal for a one-year tap at 10%. Now, if you're a consumer paying, say, 24, 29%,
Sounds like a dream come true.
it sounds fantastic.
Yeah.
But if you're a bank, it looks like the government is seizing a core part of your business model.
And let's just quickly contextualize that 29% figure. The reason rates are so high in credit cards is because they're unsecured, right?
Exactly. There's no collateral. If you don't pay your mortgage, the bank takes your house. If you don't pay your Visa bill, well, they can't repossess the dinner you ate 3 weeks ago.
So that high APR is the risk premium.
It is. It's the bank's insurance policy. Slashing that to 10% isn't just a small trim. It's like ignoring the cost of goods sold.
Which brings us to that landlord analogy we talked about. I think it really makes the panic make sense.
It's the perfect way to see it. So imagine you own an apartment building. Your rents are based on your mortgage, your taxes, maintenance, all that.
Sure.
Then, boom, the city says, starting next week, you can only charge half.
I'd panic instantly. My revenue is cut in half, but my mortgage payment's still the same. I'm immediately underwater.
Right. So do you fix a tenant's leaking roof? Probably not. Do you rent that empty unit to someone with a spotty credit history? Absolutely not. You pull back on everything.
You circle the wagons.
That's exactly what the banks are doing right now. They're trying to figure out if this is actually a legally sound executive order or if it's just, political talk.
And on that, the latest reports from this morning suggest it's moving from talk to actual policy drafting. Is there a legal precedent for this? Can a president just set private lending rates?
It's murky. I mean, normally this is a job for Congress, but the analysis we've seen suggests they're looking at emergency economic powers. Whether that stands up in court is a question for months from now. The banks have to worry about next week.
Okay, which leads us to the mechanics, because it's easy to think of the financial system as just one big thing. But the research really draws a sharp line between two types of players here.
Oh, it's critical. You have to separate the lender from the pipe.
Let's do that. The issuers versus the networks. Let's start with the issuers, the lenders.
These are the banks you know. Chase, Capital One, Bank of America. When you swipe your card, they're the ones actually lending you the money. They're taking on the risk you won't pay it back.
And their whole model is based on something called net interest margin, or NI.
Right. Simply put, it's the difference between the interest they earn from lending you money and the interest they have to pay to get that money in the first place.
So let's put some rough numbers on it. It costs the bank, maybe 5% to get the funds?
Let's say 5%, yeah. So if they lend to you at 25%, their margin is 20%. Sounds huge.
It sounds massive.
It does, until you start subtracting things. You take out operating costs, fraud protection, marketing, and then the really big one, defaults. The people who just don't pay.
So that 20% margin gets eaten up really, really fast.
It does. Now imagine this cap hits. Their cost of funds is still 5%, but they're forced to lend at 10. That margin just collapsed from 20% to 5.
And if the default rate on their portfolio is, say, 4 or 5%?
You're breaking even. or you're actually losing money on every customer who carries a balance.
So that brings us back to that pizza shop analogy.
Yep.
The bank is the pizza shop. The ingredients cost you $5. The government says you can only sell the pizza for $5.50.
And if you drop one pizza on the floor, that's a default. You've just wiped out the profit from the last 20 pizzas you sold.
It's just not a business anymore.
It's unsustainable. And when a business starts losing money on every transaction, they don't do more transactions, they stop.
Which is a huge contrast to that second group, the networks,
Yeah.
pipes.
Right. Your Visa, your MasterCard, they, for the most part, don't lend any money. They just provide the infrastructure, the digital toll road that lets the money move.
They don't really care what the interest rate is.
Not directly, no. They get a tiny little swipe fee on every transaction. Their business is about volume. How many times people are swiping, not whether they pay their bill at the end of the month.
So if you're a Visa shareholder, you're looking at this whole mess and thinking, what?
You're thinking, as long as people keep spending, I'm probably okay. In fact, as we'll get to, they might even benefit from the chaos, but for the banks. This is an existential crisis for the credit card.
Let's flip this to the consumer then. Because the argument from the White House is simple. This helps people. If I have $5,000 in credit card debt, my monthly payment drops. Why shouldn't I be celebrating?
Well, in the very short term, for that specific person, you might. If you already have the debt and the account stays open, great. But you have to look at the second order effects.
Their credit crunch.
In the credit crunch. Right now, banks use what's called a risk-based pricing. If you have a, say, 600 credit score, you're seen as risky. So they charge you 29%. That's your insurance premium.
And if they can't charge that premium?
They won't insure you. They just won't lend to you at all. They'll close the account. We could see a situation where banks just mass cancel cards for anyone with a score below, I don't know, 720.
But they'll just slash credit limit. Your $10,000 limit becomes $500 overnight.
Exactly, which is a disaster for your credit utilization, and your score immediately tanks. It's a death spiral. But there's another victim here that even people with perfect credit need to worry about. If the banks lose all that interest income, where do you think they're going to look to cut costs?
Oh, wait a minute.
The biggest marketing expense on their books.
You're talking about my airline miles, aren't you?
Your airline miles.
Yeah.
Your 2% cash back. Your airport lounge access. All of it. Those perks aren't free. They're funded by the high interest rates that other people pay. It's a giant cross-subsidy.
So you're telling me that the people carrying a balance at 25% are basically paying for my flight to Hawaii?
That's the uncomfortable truth of the rewards industry, yes. The revolvers subsidize the transactors. You take away that subsidy.
And my points are gone.
Gone. We could see a return to annual fees on even the most basic cards. Remember paying $50 a year just to have a credit card with no perks?
I do, and I don't want to go back.
Well, we might be headed there. The price of the credit goes down, but the cost of the product just explodes in other ways. There really is no free lunch.
That's a good way to put it. It leads to this twist we found in the analysis. There might actually be a winner in all this.
Yep.
And it's not who you'd think. It's the debit ecosystem.
This is the really fascinating part. So follow the logic. If banks stop issuing credit cards to, say, 30 or 40% of the country, do those people just stop buying things?
No, of course not. They still have to buy groceries, put gas in the car.
Right. So if they can't use a credit card, they switch to the money they actually have. They use their debit cards, direct transfers, cash.
The volume of transactions doesn't disappear. It just changes lanes.
It shifts from the credit highway to the debit side street. And who processes those debit transactions? Visa and MasterCard.
So the toll booth operator doesn't care which road you take.
For the most part, no. It's a reallocation of financial flow. And from an investor's point of view, you might sell bank stocks, but you might look at fintech companies focused on debit solutions as a huge growth opportunity.
But, and I feel like this is a big but, what about the people who don't have the cash in the bank to switch to debit?
The ones who are using credit to survive between paychecks.
Yeah.
This is what we're calling the shadow risk. And it's the most dangerous potential outcome of this whole thing.
Because if the bank says no to the person who needs to fix their car to get to work, they don't just give up.
No, they go somewhere else. And if the regulated banks, the ones capped at 10%, won't help them, they go to the unregulated sector. Payday lenders. Online installment loan sharks.
And the rates there are not 10%.
Not even close. You're talking 300, 400, sometimes 600% APR. The policy designed to save people from high interest rates could actually push the most vulnerable people into the arms of predators.
Because you've just removed the regulated option.
You've removed the middle rung of the ladder. It evaporates, which is the warning we're seeing from JP Morgan and others right now.
It's a game of chicken. The White House is saying, we'll sign this order. And the banks are saying, if you do, we will shut down lending on Tuesday morning.
And it's not a bluff. It's their legal duty. A CEO can't just choose to lend money at a loss. They would be sued by their shareholders. They have to restrict credit.
So as we wrap up, what do we watch for next week?
First, obviously, whether the order gets signed. Then, watch the courts. An injunction will be filed within an hour. The question is whether a judge pauses it.
And in the meantime, watch your email inbox.
Exactly. If you get an email about updated terms of service or credit limit adjustments, that's the sign. That's the banks moving first.
It's just a sobering reminder that you can't really legislate prosperity this way.
Price controls are a blunt instrument, and when you try to fix the price of a commodity, and money is a commodity, you almost always get shortages.
A shortage of credit.
There's a shortage of access. The government can mandate affordability, but if the price is too low, access just goes to zero.
So the takeaway for listeners is to be defensive. Know where you stand, and maybe get comfortable using that debit card again.
Absolutely. And maybe one final thought to leave with. We think of interest rates as the cost of money, but in a way, they're the price of trust. When the government caps that price, it's telling banks to trust strangers for free. And in a world where trust is already pretty low, are we really surprised the banks might just decide to lock the doors instead?
That's a powerful way to frame it. The price of trust. Well, thank you for breaking all this down. It's a complicated picture.
My pleasure.
And thank you for listening. We hope this deep dive gave you a clearer view of what's coming. Don't forget to subscribe and hit that like button.